can tell, our guest today is Brandy Shotwell. She is an expert in commercial lending, and she's here to talk to us about mortgage rates and interest rates. And there's a lot of news in this area, particularly with the recent Fed announcement, the first hike in 4 years. And
Yes.
so people have a lot of opinions about it, and I do too. But I try to I try to give it over to experts. So, Brandy, welcome to the group.
Thank you so much for having me, Daniel. So, yes, rates are on the rise, and I always like to start out with this. So, I've been in this industry over 20 years, and I've been through the ups and downs of all the real estate cycles. And even though rates are on the rise right now, they are still historically low. And I know there are so many people out there panicking. And it was kind of, we started out with, okay, the feds are going to raise the rates. Rates went up. And then we also, following that, had unfortunately what happened with Ukraine happen, and then that has caused even more volatility in the market. And I think everybody is just really going crazy right now, trying to figure out what to do next and, what's going to happen next. So I have several opinions about it. I don't know how many of you all are already invested in real estate or are investing in real estate, but I assume you're in this group. So you're either interested in investing in real estate or you already are investing in real estate. So right now, as Daniel mentioned, I only do commercial real estate. So I can only speak for commercial real estate. And specifically for me, I specialize in multifamily. And so I will specifically talk about those areas. But one thing I will say before I get started on where I think the market is going to go, I want to kind of talk about the asset classes. I know that's an interest to a lot of people. Obviously, real estate is a great place to be, especially when inflation starts to happen. A lot of investors worry about where to put money and what to do. But uh, multifamily I don't want to call it recession proof, but it is very close to being recession proof when it comes to making investments in a down market. So you have people that will move from A class investments over to B and C class to save money. You have homeowners that will, either lose their home or sell their home, and they will move into apartment complexes. And so multifamily is a very good asset it performs well in an up market, and it performs well in a down market. Another asset class that I like to mention is storage units. I don't know how many of you all are invested in storage, but storage is a wonderful asset class. It's not, I don't want to say recession proof, but it does perform well in an up market, and it performs well in a down market. When people are moving out of these larger homes or larger apartments into smaller areas, they're always going to, go to storage. So you'll see a lot of investors invest in there as well. So when it comes to interest rates, the most popular types of loans that we do on the multifamily side are Fanny and Freddie, HUD. Those are what we consider agency loans. And then you have your bridge loans. And I know a lot of people hear bridge and they automatically like freak out, like that's high risk, that's high rate, and that's not always the case. So with Fannie and Freddie, when the feds increase the rate, and we've seen when feds first made their announcement, slowly over the course of a few weeks, we've seen a rate increase on the agency side of about up to 60 basis point increase in rate. And that's kind of big. That's a lot, right? To have such an increase in a short amount of time. And so where we were usually, let's say, in a 3.25% to 3.5% range, we're now like in a 4.25% to 4.75% range. So that's more of 100 basis point spread that I'm giving you, even though I said it only increased 60. But there are a lot of compensating factors that go into what determines your rate. So there are most of our products for loans under 7.5 million, which is considered small balance, is um, in the four. You will see a four. You will see a 4-digit number for your interest rate. And a lot of my investors are still doing bridge loans. And a bridge loan, if you don't know what that is a loan that bridges you from purchase to stabilization. And you take that loan, it's a short-term loan, usually less than 3 years. They have extension options on those loans, but the good thing about those loans is that you're able to get all the capex rolled into the actual loan. So usually, when you can take out more debt instead of using equity, your returns for your investors look a lot better from the syndicator side. So with that said, they are they basically have to have like a crystal ball to determine where the rates will shake out in 2 years or 3 years once that property is stabilized. So a challenge that we're having is, okay, well, we were using 4.5 or 4.75 in our underwriting for our properties, and now those rates are almost there for some loans. So there's a lot of caution out there. I'm instructing investors to still buy because this is still a good time. The rates are still historically low. If you can find a property where in an area where you don't have compressed cap rates, you can still get in and execute your business plan and do very well in the market. And I was just at the Best Ever conference. Daniel, were you there? I didn't see you there. You weren't there.
No.
Okay. So I
I
was
should
just at
be,
the Best
but I
Ever
wasn't.
Yeah. I was just at the Best Ever conference, and I was on a panel with some other amazing folks. And they were saying the exact same thing. Like, this is still a great time to buy. This is still a great time to invest. Anytime there is a volatility in the market, you're going to see, in my opinion, what's going to happen is we're going to see some of those compressed cap rates balance out, and they won't be as compressed. Sellers won't be able to be as greedy and aggressive as they have been, because with the rising interest rates, we're expecting the pricing to kind of come down a little bit. And I think we'll probably see that on the single family side as well. In Texas, I can't speak for Texas. In Texas, it's a little crazy right now. And I know some other markets are the exact same way when it comes to residential real estate. But on the commercial side, what I see happening is more of a balance. And I think that's before the situation happened with Ukraine. I think that was the goal of the feds, to try to slow things down a bit, balance things out a bit, and say, okay, we're going to get this Fed rate up to about 2%, where it's been almost at zero. And so it's more of a balancing act, and I think that that's the goal that they're trying to hit. I don't think that that what they want to do, if they raise rates too high, they're going to push us into a recession. And their goal is not to push us into a recession. Their goal is just to kind of balance things out. When they made that announcement, and then everything happened with Ukraine, I have not seen a rate increase on the actual loans for Fanny and Freddie in a few weeks. I think it's been about 3 weeks since I've seen an interest rate increase. And they said it'll probably be there for a little while. And what I'm hoping is that we can kind of maintain this before they bump it up again. And go ahead.
Oh, I was going to say, if
something?
you have questions, feel free to put them in the chat, and I'll just judiciously interrupt you, Brandy, every once in a while. But at
Yeah.
some point here, I kind of want to maybe dialogue a little bit, just to tie some
Yeah.
of the commercial terminology that you're mentioning to, because not everybody here is a commercial investor, but kind of
Yes.
go
So
over,
let me
like,
help. Let me help with
yeah.
that.
So I was going to say, first of all, one of the questions that I have is that both residential and commercial rates are based on the rates that the Fed is setting, right?
Yeah.
So we kind of knew that they were going to do a quarter point, uptick in the meeting on Tuesday.
Yeah.
How early before that did you actually see rates start going up?
I didn't.
Okay.
Rates were not going up. They were not going up. They were kind of like really even keel towards the end of 2021, which is typical. We'll see an increase in rates, but they came right back down at the first of the year. So I did not see, I knew it was coming. So I don't want to say I didn't see it coming. I knew it was coming, but it had not physically happened.
Okay, that's interesting because I've been looking at residential rates here recently too, and residential rates, the banks have been going up slightly. Even a couple of weeks ago, they were moving up. I
Yeah.
just was quoted a loan at 5%, so which
Oh, wow. Are you serious?
yeah,
Wait,
yeah,
residential was like two and a half a while ago.
yeah,
Can I
Yeah.
piggyback
Okay.
on top of that?
yeah.
Yeah.
So my experience in the past is the Fed's really good at telegraphing their intent many months ahead of time, and that's usually where the market starts to stabilize and pre-adjust, if you will, for whatever those rates are. And
Yes.
we knew they were going to raise, we knew they were going to come up. They've been very, very transparent with that. And I would have expected that the rates would have been, loaded into the market months ago in anticipation. But you're saying, Brandy, that this time that's not true, or that's a commercial
Yeah.
specific comment?
Commercial specific comment. Commercial specific. What we've seen, it's been about 6 weeks. And over the last 6 weeks, we've seen a 60 basis point increase on our agency rates. We didn't see any increases on our bridge rates until the situation with Ukraine happened. So yeah, on the commercial side, they were still trying to keep rates steady. They knew they knew it was coming. And about 6 weeks ago is when we started seeing the increase. It was like 15 basis points this week, then nothing, then another 15 or another 20, and total has been almost 60 across all loan products.
Do you see lenders clamping down on other types of, provisions on the loans? Like, so one difference between residential and commercial is commercial has prepayment penalties. Is anything in terms of that changing, or IO interest only sections, those other
Yeah,
attached terms?
yeah, that's a good question. So one thing I can say, two things. First thing is what I am seeing is them scale back. Daniel, we've been able to get 80% on the majority of a lot of assets. I've been instructing investors to kind of scale that underwriting back to 75% because, especially in the smaller markets. So, if you're in a smaller market or tertiary market and you're investing there, just be prepared to put down a little bit more and to come up with more equity. So I've been instructing investors at 75% because I'm seeing the bank scale back to that 75% number versus that 80% number. Um, the other on the agency side, I don't know if you did any agency debt during from the start of COVID till now, but if you did do any type of agency debt, then you would have seen that you would have experienced the multiple tumultuous red tape that you had to go through. So there were a lot of audits involved. There was a lot of digging. It was extra paperwork, extra requests, and it was just painful. So the word that I got at the conference, MBA conference, which is a conference for finance where all the bankers come together, the word that I got was that that's going to stop. So it won't happen right away, right? They're going to scale back on that as rates go up. That is the one thing that they're going to do is kind of relax a little bit, like, okay, we don't need the reserves anymore. We won't have to do all these extra audits. I remember last year I closed a deal that had it was like 150 unit, and it had uh, two or three students, and Freddie did two audits on it, lease audits, and it took like an extra 3 weeks to get it done. It was painful. So what I did here is that they're going to scale some of that back, and they won't be as difficult to work with.
The area that I actually had more trouble with was on reimbursements on capex expenditures. So, for those of you who might not know how this works, when when you have a commercial loan and you go in and renovate a unit, you actually have to pay the property managers, or the LLC which owns the property has to pay for those, out of pocket or out of available funds rather. And then they go and request a reimbursement from the bank out of the money that it is held in escrow from the closing. And we were seeing a fair amount of scrutiny on those reimbursements. I don't know. Did you hear anything in terms of, will they be lightening up there a little?
Yeah.
Probably not.
No, I don't think so. I didn't every now and then we would have an issue with disbursements, but I would kind of jump in and help any way I could to kind of push that thing through. But I think that had nothing to do with the market. So I'm going to say that probably will not change.
How many people here are actively looking for a loan right now? They're refinancing, their home, their property, their investment properties. Just put it in the chat if you are. Nobody, huh? Okay. Well, all right, we've got some people here. Okay, so I
Yeah, I'm
guess I
trying to
want to
look for the
ask,
chat so I can see.
is now we're expecting more rate hikes. And
Yes.
what's your prognosis there?
Okay. So as I recently stated, I do not think that the rates are okay. Let me backtrack a little bit. Rates are still historically low. So when I first started in this industry back in '99, I can remember multifamily, because I started on the single family side. I can remember multifamily starting at the double digits, right? And then they kind of came down, and I think the average was like 8 or 9%. So when I compare that to where we are now, I'm like, I don't think rates are going to go there. We're expecting more rate hikes, yes, but I do think that they're going to be conscious of inflation. I would hope that they would be conscious of inflation. I would hope that they would be conscious of, the volatility in the market. And I tend to have a more optimistic outlook, but I do not think that we're going to see such a huge swing in rates that we're going to see maybe a 200 basis point spread by the end of the year. I don't think that's going to happen. At the end of the day, they want to keep the cash flow going. They want to keep the market moving. I think what they're trying to do is just to slow us down a little bit, which, I don't know. I think it will probably take at least 2 years of interest rate hikes for us to see like a 200 basis point spread. We're almost at 100 basis point spread now. But now remember, just because the Feds increase, it does not necessarily mean that on our side, now I can only speak for commercial, that on our side, we will see an increase on interest rates. So, they do have some type of buffer in there already. So, if the Feds come up 25 basis points, maybe the lenders only need to move it 10 basis points. They don't need to necessarily move a lot. So, and I do think that what's happening with our country and our world right now with wars and bombing, and I think they're going to have to be conscious of all that and not raise the rates. You can't raise the rates when all that's going on. You just can't, because then you'll start a recession.
Yeah, and I think that it's healthy if the economy
Yes.
can take it to do so.
Yes, I know, and I 100% agree. I mean, as well as I do, Daniel, like these compressed cap rates across these markets, it is crazy. When I went to the chat, I saw someone talk about Phoenix. Arizona is just crazy. Dallas is crazy. Atlanta, some of these other markets, I mean, it's ridiculous right now. So I think that pullback will actually be beneficial to those of us that are investing. I think it will help balance things out, slow things down. Um, and one thing, and I know you can attest to this too, there's so many people that don't have the experience and the knowledge trying to jump into this market, and they're underwriting very aggressively. They're offering way over asking on the apartment complexes, multifamily side, um, and they cannot sustain that. That cannot keep going year after year. It just can't. So I feel like this is that pullback that we need, that is going to be the serious investors, the experienced investors that make good decisions, that know what they're doing, that underwrite conservatively. Those will be the last ones standing when it's all said and done. And I think there are going to be some really good buying opportunities, because those operators, even on the single family side, that were just too aggressive in their approach when they acquired the property, they're going to have to sell, and they're going to have to sell at a loss. So I think, to be in a good liquid position to be able to take advantage of some of these opportunities that will come along over the next few years is great.
We've got one question here from Claudine,
Yeah.
and they are asking for what I'm looking for a process on how to own a commercial building, steps 1 to X. So can from a loan perspective, can you walk us through,
Okay.
like, how does it work? From beginning to close, I suppose.
Yeah, 100%. So the first thing that I ask investors to do, my clients, is to work with me when you are out there looking for a property. Because Daniel knows this too, is that when you're looking at property, you need someone that can underwrite it for you, kind of give you some stats on that property that you may not be able to get on your own. Kind of take a deeper dive into the T12, into the rent roll from a financing eye, to see if this property is actually good. Are you going in at the right price? If you know that there may be some challenges on that property, you may not go in at full asking. You may come in a little bit lower. So it's important to kind of build your team beforehand. But once you have a property under contract, and all the loans that I do are non-recourse. Daniel, I don't. Is everybody kind of familiar with non-recourse and what that
I
means?
wouldn't
No.
assume
Okay.
so. I bet
Okay.
plenty are, but yeah.
Okay. So commercial non-recourse means that you are not personally liable, 100% personally liable. There are certain carve outs, which the most popular carve out is fraud, but uh, that's kind of the biggest difference between residential investment and commercial investment, is that residential, you are personally liable, and those loans are recourse. And on the commercial side, not all commercial, but on the multifamily side and some of the other loans that are available for other asset classes, there is non-recourse debt available. So you're not personally liable for it. The loan is asset based, and it's completely based off the asset. So unlike when you're buying a single family home, there's no pre-approval process for you to go through, because we do asset based lending. So until you find an asset, there's no type of approval process that we can go through. So once you find the property, you would send over the financials. You would send over the offering memorandum, which is kind of like a deck or package from the broker that details everything about that property. Not every property has that, but most of them do. And we would do a full underwrite on that property and prepare a package for the lenders to submit out. So I am a mortgage broker. I'm not a direct lender. That means that I work with hundreds of lenders that are out there, and basically I would submit your package to those lenders and get the best deal, available for you. And I would come back to you with several term sheets. You would take those term sheets and review them with your team and make sure that, hey, this is the right one for us. Some of them may have higher leverage. Maybe some have a lower interest rate. Maybe some have more flexible terms where, you can get out at any time, or a cheaper exit fee, which is also exit fee equals prepayment penalty. So it just kind of depends. Once you select a lender, then we would work hand in hand with legal and title and the broker and the property manager, the incoming property manager, to collect all the dots to make sure that we have everything together. And we usually close in 45 to 60 days. So that is the process. It's not a very painful process. And having been on the single family side and can compare to the commercial side, commercial is a lot easier. It's not as much paperwork. And surprisingly, right? It's not as much signatures. I remember when I would sit down with clients on the single family side, they would have to sign a stack of disclosures like 50 pages, 30 pages. And so it's a little bit different on the commercial side. But in short, that's the process. Does that answer all your questions?
We would have to have that person speak
Yes,
up to
yes.
Yeah,
let us
I'm
know.
going back.
Yes, thank you.
Yeah, okay.
Are there
good.
any other questions? Feel free to take yourself off mute.
So there are some questions in the chat.
Okay, so
You want me?
what exactly? Yeah, go for it. What's the qualifications? Henry, or sorry, is it Henry? No, Surya is asking. He asked what the qualification is for a commercial property. What makes a
So
property?
yeah, yes, 5 or more units. Somebody did say that. Oh, did you answer that? Yes, it has to be 5 or more units to be a commercial property, and it's still considered commercial, but it may not qualify for the type of financing I do because my loan amounts have to be $1 million or above in order to qualify for a Fanny or a Freddie loan. So, but in the real estate world, anything over 5 units is considered commercial.
What about like gas stations or things that are up that might be on the border in people's minds between commercial and I mean, obviously a gas station's commercial. But
Yeah.
I tend to think of commercial as like office space or retail space. What about things that are kind of in between, shops? Do they qualify for these types of loans?
So they don't qualify for Fannie or Freddie. In those instances, I would use either bank debt, or so literally working with a local bank in the area, or what we call a CMBS loan. And a CMBS loan for gas stations is a little bit different. We use SBA for gas stations, but for office, for retail, for industrial, then we typically use CMBS debt for that. And CMBS is just commercial mortgage-backed securities loan. And it's typically not used for multifamily because it has a hefty prepayment penalty. And so when you're taking out a CMBS loan, it's on an asset that you intend to own for at least 5 or 10 years before you sell.
We're getting some good questions in now.
Yeah,
I'm going to start with wrong. And you don't need to keep up. I'll keep up for you and ask them to you. So you concentrate on being awesome up there and spilling knowledge.
Okay.
And
okay, cool.
and
I'll come back
read
to
the
this
chapter
screen then because I was like trying to keep up.
Yeah. So wrong is asking, what is a Fannie loan?
Okay, so a Fannie loan, a Fannie and a Freddie loan, you've probably heard both terminologies. Those are loans that are backed, insured by the government. So kind of what you on the single family side, your FHA is actually the exact same thing on the commercial side, if that makes sense. And so they have it's a little bit more red tape that you have to go through than going through, maybe your traditional bank or some of your debt funds. But investors like them because they're non-recourse, they're low interest rate, they're amortized over 30 years, and you still get an interest-only period. So it helps with cash flow when you first acquire that property. So they're very good loans to use on multifamily asset classes, student housing, and military housing. You can also use it for that.
Yeah, one thing that people might not.
And
Go ahead.
what is the I can't believe I'm drawing a blank. The senior living, senior housing as well. But what were you going
Yeah,
to say, Daniel?
I was going to say a lot of people don't realize commercial loans have a different time period. You mentioned they're amortized over 30 years, but how long do
Yes.
they usually last?
So 5, 10, 5, 7, 10, or 12 is usually when, and they actually balloon. So they may be amortized over 30 years, which helps with your mortgage payment, but they will balloon in 5, 7, 10, or 12 years are the typical time frames for those loans. And so you will have to refinance or sell, at that time period. I think they give you like, you probably want to start the process a few months before it's time for your loan to expire and
I
balloon
like you.
out.
I like Eugenia's question here because this is what a lot of people think about. How can one identify properties that will have to sell at a discount due to interest rates?
Ah, so really what, and I know Daniel can attest to this too, is really just having the relationships with the brokers. Because anytime a property owner or operator is in distress or needs to sell quickly, they're going to go to a broker. They're not going to try to sell it themselves. They're usually not going to let it go into special servicing where there's some list of potentially foreclosed properties. So building those relationships with those sales brokers is key, because they will reach out to you directly and offer you off market deals if they know that you can close.
Lucas wants to know what sort of loans do laundromats need?
Mm.
I don't know if that's in
So
your area or not.
yeah, I have not done a property with a laundromat, but I would say an SBA loan would probably be the best case for a laundromat as well. Um, the laundromat it has to go, they will probably make you do some type of reserve and hold back because of the environmental issues surrounding a laundromat. I have closed loans on properties that had laundromats in them at some point in that history of the property, and there were environmental risks, and we had to do holdbacks for it. So I imagine if you were purchasing an actual laundromat, you would have that same thing. But I would totally go for it. But I think SBA would be the best bet for that. And the thing about SBA loans, if you're purchasing a restaurant, a gas station, a laundromat, the SBA will provide up to 95% financing for you to acquire the property and the equipment for that building. So that would be an SBA loan in my eyes all day.
All right, we got a lot of good questions coming in.
All right.
Daniel,
Yeah,
I had one that is kind of complicated, and I'd like to ask rather than writing in the
go for it.
chat. Thank you, Brandy, for
Yeah.
all of your information so far. And I realize that you're focused on commercial, but I'm in a dilemma right
Yeah.
now where I've put a deposit on a home that won't be ready till the winter of 2022. And as we know, uh, projections like that, there will be delays. So I'm probably February 2023. And with the interest rates projected like 7 interest rates hikes by the feds, but you also mentioned that doesn't necessarily mean that lenders will increase their rates. But I guess my question is,
Exactly.
should I back out of it? Because for the pre-approval, I
Oh,
got 4.675%, but there's a couple things playing. Is like, I know that there will be equity in the home because of the price of the home now that I'm getting, and then by the time that it's
yeah.
built and ready, I'll probably have 50,000 in equity in it,
Yeah.
projecting. But I mean, do
Maybe
I walk away?
another question here is, can you lock your rate before the
Uh,
interest rate hikes go in?
You can't lock the rate,
Not
Yeah, no.
not this early. Yeah.
not this early. You can't. So lucky for you, my husband is a developer, and so we are experiencing the same thing with the clients that he is building homes for. And so a couple things. One, what he's doing in his clause is he has a clause in the contract to protect the client for price increases, right? So to protect him and the client. And so they're allowed like a 15% increase before the price of the home actually increases. So one, I would go back, because to me that would be a big, that would be a huge decision for me. I would want to know, will I have that equity, or will that equity be used because the house will cost more because of all the supply issues that are going on right now? And if they're promising to lock you in on that price, I would probably just go with it.
Okay.
But one thing I would tell you I would do is I would take, if you could take the paperwork that you've been provided and maybe calculate what it would look like if it was 100 basis points higher, what that does to your payment, what that does to your debt to income ratio, and see if it's still worth it. So
Okay.
one, check the price and make sure that your price is locked in, and make sure that you're protected. You want to make sure that they can't come back and say, oh, well, with the supply chain issues, it's going to cost, 100,000 more than what we thought. So you want to make sure you're protected there, because then that's going to answer your question on the equity. And
Okay.
then number two, you want to make sure that, that it's affordable for you. If it goes up, what does that do to your debt to income ratio? What does that do to your budget and your finances if you have to take a higher interest rate?
Okay. And then when you say base 100 base points or 100
Oh, yes.
base,
Okay.
what does that
So if it
points?
goes up 1%,
Okay.
so right now you're at a 4 point, what did you say?
8675 for the
So
pre-approval.
see see
What
what
happens if
happens
at
if it goes up
5.6,
to
5.7?
5.675.
Okay.
Yep. See what
Thank you.
happens for you. Does it still make sense for you to do?
Okay.
Yes,
Thank you,
you're
Daniel.
welcome.
Yeah, yeah. And just to give the standard disclaimer here, right? You make sure you review your own situation and consult with your own financial advisors. This is educational only.
Yes, yes,
Um,
yes.
but so Uzo, well, really quickly, Wei is asking a question. Can you use a commercial loan on a single family house?
You cannot. You cannot. The only time that will work is if the property is actually zoned commercial. So I know you've probably seen it because it happens in every city or town where, a certain residential area is zoned commercial. And so people start turning these single family homes into office spaces or retail spaces. In that case, you can, but that's the only time. So technically it's a single family house, but it's no longer anymore because it's in a commercial zone.
And that's actually a really interesting business plan. I know some developers over here in Portland, their whole business plan is they go in and find these houses that were built in the 1940s that are on properly zoned land, and they're single family homes, and they'll tear down the single family home and put a 12plex, like a 3-story 12plex in its place. And they're doing it right,
Wow.
in the middle of Portland and still turning money doing that. And so it's,
That's
you can find some
awesome.
creative business plans that way.
Oh, 100%. Yeah.
Yeah, Uzo's got a good question here, and I hope I
Okay.
said your name correctly. If the loan is
You did.
collateral, okay, good. If the loan is collateral based, what amounts of collateral are you looking for on a typical 3 to 7 million small cap loan?
So if the loan is collateral based, what type of collateral are we looking for?
Yeah.
So the asset itself is the collateral. So what we want to know is what's the cash flow of that asset. So if you spend 3 to 7, if you spend $3 million on a property and that property is vacant, it's not cash flowing. So even though you're spending 3 million, if it was cash flowing, it could possibly be worth more. So we take an approach off of business plan, cash flow, and proposed what are you going to do with that property. So for instance, if we're looking at a multifamily property that is 90% occupied, that's considered a stabilized property. And then we're going to look at cash flow, and the value of that property will also be based off of the cash flow. So the property itself is the collateral, but also what the cash flow is and what the business plan is for that said property. If it's a, depending on the type of loan it is. Does that answer your question?
Yes, it does. And so basically,
Okay.
What you're saying is you don't need the main principle is that the asset itself is the collateral.
Correct.
I would even add to there too that in commercial loans, for the most part, they're not even going to check your credit, because not only is the asset collateral, but the asset's income is what is going to show the bank that you can pay or not.
Correct. We're not looking for, the only thing that my clients provide to me is a personal financial statement that is signed. So I'm not looking for pay stubs. I'm not looking for life insurance policies. I'm not looking for them to prove out anything. I need a personal financial statement, and I need bank statements to show they're liquid. And that's it. So yeah, it is completely based off of the property.
All right.
Thank you.
Let's see here. Surya's got a good question. Actually, Eugenia's got a question here on, does Brandy think that we will see non-performing notes? Should we stay away?
No, I think that I've talked to several people over the last few months who are like waiting in the back and like salivating to invest in certain places in certain things in real estate. So no, I would say non-performing note, maybe I don't know enough about them to speak on them. I know enough to be dangerous, but it could be a good investment for you to do. But I think that from an investment standpoint, if you cannot find the right investment for you now, make sure that you are capital ready, because there are going to be a lot of opportunities. And not saying that everything is going to foreclose and this is going to be 2008 all over again, but I think there will be a lot of good opportunities coming. When you couldn't find that property that fit or that investment that fit, I think you will be able to soon. And so, yes, a non-performing note. I know a guy here in Dallas that does non-performing notes, and he is doing very well. So I think it's a pretty good business.
We've got a couple of speakers who have come into the club before and talked about non-performing notes too. And I'm sad to say I'm blanking on the name of the speaker, but he was actually an Intel employee. And he came in here and he's got quite a good note business going on the side.
Yeah. I hear a lot of good things about those. I almost invested in one, but I felt like I wasn't educated enough to know about it. So that's the one thing I will say is, anytime you're thinking about investing in something, always get educated on it.
All right, lots of good questions here. Surya had some questions, and I just lost them in the chat. Where'd they go? He is asking, here it is. What's the current interest rate for a multifamily if the project is around 5 million? And here's the part of the question that I think is really good. Can we get all the amount as a loan without any personal investment? So I'm going to reword that to say, do commercial loans require personal investment?
Most of the commercial loans will require you and your team to invest 10% of the equity required. So not of the purchase price, not of the loan amount, 10% of the equity. So if it takes, $5 million, or let's just say $1 million in equity, then they want you to put in $100,000 of your own money. And it doesn't have to come from one person. It can come from the whole team that is signing on the loan. So yes, the answer is yes. And it's 10% of the equity.
And then his follow-up question is, can we get a commercial loan for buying land without any down payment? I mean, they're always going to want a down payment, but what about a commercial loan for land?
Yeah, so I have personally some of those myself, and the answer is no. It would be nice. But
So your
if
husband,
you find a good, what were you gonna say, Daniel?
oh, go ahead. No, go ahead and finish.
Yeah, if you find a good local bank, which is what we did, we found a good local bank, and our down payment was about 20%, which is very rare because normally the down payment on land is about 40 to 50%. But they understood our business plan and what we were doing with it, and they gave us 80% leverage.
Now, you mentioned
So
earlier that your husband is a developer. Now, he
yeah,
goes in, I assume, and buys the land, right? And he's got to get a loan
yeah,
to do that. What do those
yeah.
loans look like? And tell us a little bit about
Oh,
that.
they're yeah, of course, they're interest only. And I think on ours we got like a 375. On ours, the loan amount was like 1.5, I think.
Okay.
Um, on the current project that we're on. But yeah, so interest only, uh, 1 year term with a 1 year extension. Um, and as you develop and you sell, then that they create a takedown schedule for that. So you sell the house, and then that brings your loan balance down as well. Yeah.
Okay, so a couple questions there. Is that considered a construction loan, or is that a different type of loan?
No, that's a different type. So we did a land loan, and then we did a line of credit to use to do the actual developments.
Okay, and this is for a single
Yeah,
family home, right?
single family.
Yeah.
Yep,
Okay.
yes,
Okay,
single
and then
family. Yeah,
then
so
you.
it's two different loans, but same bank, so they were able to, structure it, line it up together.
Okay, so that's interesting. They they
Yeah.
they came up with the whole process all at once and executed two loans
Yes,
over time.
exactly.
Okay, and
Exactly.
then you
Yeah,
said
because we
that.
had the land loan for like, oh, I was just gonna say we had the land loan for like 6 months before the houses actually started being built. So yeah, they were able to do both. Yeah.
Okay, and then you said that when the house is sold, you're able to. Do they ask for that loan to be paid all at that point when you sell the house, or is there? You said there was like a pay down schedule, and I didn't quite understand that.
Yeah, so there's like, yeah, so say for instance you sell a house. Um, so our these are luxury homes, so they're pricing over the $1 million mark. So when a house sells, then there's like a 25% of um it's about 25% of that sale that's going to go towards the loan for the land to knock that down for each house that's sold.
We're getting quite a few questions here, and I'm skipping around a little bit
Okay.
now, but around
Okay.
helocs. And I think the question
Uh,
also kind of comes down to variable rate loans right now. What's your opinion of a variable rate loan right now?
yeah, if I was variable can be tricky, and what you want to do is you want to use your worst case scenario to stress test it. So I don't care what the investment is, just make sure that if it's X amount of rate today, let's say it's 4% today, make sure it can go to 7 or 8% because it's an investment on the single family side. I know your investment rate is always higher. So you just want to use a higher threshold. Now, on the commercial side, we use rate caps. And so rate when we do variable loans, we put a rate cap in place, and that rate cap is like an insurance policy for that loan. And it protects you in the event that the rate goes up and there's a strike price. So if the rate goes up 1%, you can choose a 1% strike or 2% strike or 3% strike. So if that rate goes up 1% or goes over that 1% increase, then that insurance policy, that rate cap, is going to come in and pay the difference of your debt service. So on the commercial side, we can put a rate cap in place, but that is not available. I'm a little rusty on the single family side, but um, on the single family side, it's not available. So I would be a little bit more cautious on the single family side doing a variable rate. And if you did do a variable rate or like a home equity line of credit or something like that, the helocs, just kind of use your worst case scenario. What, where do I think the rates are going to go this year? And, am I still okay if that rate jumps up 200 basis points or 2% or 3%? Am I okay? Am I protected?
And just a 3-minute warning. We've got 3 minutes left in the call. Young is asking question on delayed financing of single-family homes. Would lenders lend up to the purchase price of the house if the house price is below the appraised value?
Would they lend up to the purchase price? So typically they're going to give you a percentage of the purchase price or the appraised value, whichever is lower. That's the rule of thumb. So I don't think that there's 100 or 100% financing program out there. It used to be when I was in single family years ago, but not now. So they will give you a percentage of the purchase price or the appraised value, whichever is lower. Did that answer that question?
Probably.
Okay.
So Lucas is asking, do I need a real estate license for commercial purchasing or going to deed auctions? Do you need a real estate license for commercial?
No.
I don't have a license, and there are pros and cons of that, but
yeah,
I
no,
don't think
you
a lot of
don't.
investors
You don't need one. No, a lot of investors do not. If they do, it's because they used it on the single family side and they already had it.
Is there a commercial equivalent? That's a good question, Glenn Cochran. Is there a commercial equivalent to tax auctions for single family homes? So is there such a thing as tax auction for commercial homes or commercial properties?
No, so this is when a commercial property, so usually all commercial debt is escrowed at closing. And just a little tip on the commercial multifamily, the foreclosure rates are less than 1%. They're very low. And when you own a commercial property, that bank and that lender they're going to work with you. Your asset manager is going to work with you. So if there's a tax situation where you're behind on taxes or something like that, it would never go that far because they have too much to lose, I assume, but it would not go that far. So I do not know. I am not aware of anything like that available on the commercial side.
All right. 2 last quick questions. Kayla is asking, and feel free to say no if that's the case. Do you mind sharing what builder is letting you lock the price of the property until build completion?
No, I don't. I know I don't. What I was asking the gentleman, I think his name was Mike, that was asking, I was asking him, was he locked in on his pricing?
All right. So and then lastly, hey Brandy, can you share your contact information for people that want to reach out to you?
Yeah, absolutely. The best thing to do is just go to my website. It's is that okay to share my website?
Yeah, absolutely.
Okay. So it's Reno, RENOCM.com, RENOCM.com. And my phone number is there, my email is there, and all that good stuff.
All right. And I'll drop it in the chat.
Can you hear?
Yeah,
Thanks, Brandy.
Hey, everybody, could you take yourselves off mute and say thank you to Brandy?
Thank you, Brandy.
Thank you, Brandy.
Thank you,
Brandy. Really appreciate it.
Thank you,
Brandy.
Brandy.
For having me.
Thank you, Brandy. This
Thank
was
you
awesome.
For having me. Oh, thank you. Thank you for having me. Thank you so much, Daniel.
Yeah, thank you. It's awesome. We gotta have you in here more often.
Yeah, absolutely.
I can't believe we've been doing this for like 2 years and haven't had you in yet.
That's so good. Crazy. That is so crazy. Well, I love it. I would love to come back.
Thank you so much. Really appreciate it. Thank you.
Thank you. All right. Well, thank you guys. I'll see you later.